Ladies and gentlemen, hello and welcome to The Age of Alternates, a podcast series presented by Vivriti Asset Management. In this series, we try and demystify the world of alternates. In today's episode, we talk about the recent trends in AIF and the impact of the amendments in the industry. To understand the topic in the best possible way, we have with us Alekh Yadav, the Associate Director and the Head of Investment Products at Sanctum Wealth, a Mumbai-based full-stack wealth management firm that manages over 19,000 crores of assets and more than 1,100 high-net-worth clients in India as well as abroad. Alekh comes with rich experience of more than a decade in investment research and wealth management. He has been with Sanctum for nearly 4 years, identifying and reviewing PMS and AIF product ideas. Great to have you with us, Alekh. On the other side, we have Dipen Ruparelia, our product head and a member of the founding team at Vivriti Asset Management. Dipen has been phenomenal in creating our products that attracted over 3,000 crores of commitments and has an impeccable track record of nil defaults. He comes with more than 1.5 decades of varied experience across fund conceptualization and structuring. Gentlemen, we look forward to an informative and interesting conversation. Over to you.
Thanks, Ishan. Welcome, Alekh. Pleasure to have you.
Thanks so much for having me today.
Given the topic is on alternatives and the recent trends and recent changes which you've seen from regulations and taxation, I'll maybe first start with the first question, which is in terms of, given that we have now through more than a decade of the AIF regulations coming to fold from 2012. We've actually grown at a very healthy pace of more than 50% growth YOY over the course of the last 5 years. Is there anything which the regulators or the industry could have done better to see maybe even higher growth? Or what are the steps which have actually got missed to ensure that the growth could have been even better? Now, that's the first question which I want to start with.
Sure. Thanks, Dipen. If you look at the AIF industry in the last decade, large part of the growth has happened in the last few years. We have seen many asset classes which were launched just in the last few years. For example, categories like structured credit, venture debt, and for that matter, even PE and VC investments by HNI investors have only picked up in the last few years. So while it may look like a substantial increase in commitment as highlighted by you, it's come on a low base. If you look at the overall fund raised by AIFs, Category 1, Category 2, and Category 3, it comes to close to 7 lakh crores versus an overall mutual fund plus PMS AUM of about 45 lakh crores. That is roughly about 10 to 15% of the overall AUM. A large part of that is held by institutional investors, and HNI investors are still significantly underpenetrated when it comes to AIFs. If you look at the average allocations to alternates in a HNI client portfolio, it typically tends to be about single digit or low double digit. Globally, that number is closer to 20-25% of the overall portfolio. We believe that as some of these non-traditional asset classes develop over the period of the next few years, we should see a significant growth in alternate assets, and the number which is right now low single digits, high single digits, low double digits should increase going forward. In terms of regulations, while regulations have been supportive and the framework that SEBI has kept is quite stringent, there is a little bit of room for flexibility, especially if you're looking at growing the absolute alternate universe of the AIF, and move beyond the traditional asset classes that the AIFs are serving. I think that is a little bit of room to grow, but otherwise, it is just a matter of time. We are seeing more and more interest from HNIs when it comes to AIFs.
Yeah, okay. To that, probably I'll also add a point that Cat 2, for example, is the major category which probably occupies more than 80% of the commitments. Given that, I think one of the point which the regulations are still not aligned is on taxations of Cat 3 not being accorded pass through, which actually could be a relatively dampener in terms of that category sort of really picking up globally. For example, the hedge fund category or the other categories which sort of operate in a Cat 3 scenario with leverage. We've not seen funds taking leverage. I think those aspects the regulator maybe can sort of look towards enabling, although maybe with some restrictions. I think leverage at the fund level is something which could be allowed in a better way. We've seen constraints from domestic banks lending to AIFs, and that I think few of those points are which are potentially still unaddressed, and those could be looked at.
Absolutely. If I may add, Dipen, to that point, is that is what I meant when I was talking about flexibility. If you look at the category 2, which is the PVC real estate, that segment has seen significant increase, and large part of the commitments are held by them. But the category 3, which is hedge funds, if you were to count hedge funds in India, you count it on your fingers. Globally, hedge funds is a much larger asset pool, and for that to develop, one needs to see greater flexibility of the kind of investments one can invest in, and as you said, the ability to take higher leverage, of course, with the right set of regulations and guidelines to check that they unnecessarily don't add on risk.
Yeah, that makes sense. We are at the start of the fiscal. Most of the wealth houses and wealth houses like you would reorient towards and frame their tactical asset allocation calls. Given the global and domestic macro backdrop, and we've seen rising interest rates, higher inflations, equities are subdued. What is your house view in terms of tactical asset allocation decisions amongst other asset classes?
Sure.
And then we'll sort of take it from there.
Sure. So, as you rightly said, we are in an environment of high levels of ambiguity. If you look at the noise around US recession, that's amplified in the last few months. However, global equity markets have remained resilient, surprisingly, throughout this year. The US economic data is showing some amount of slowdown, but isn't really rolling over as quickly as what the expectation was. There isn't any consensus on growth, inflation, or the future rate course that the Fed may take. However, we believe that we may have entered an environment of stagflation, basically an environment where growth is likely to be low and inflation likely to be elevated, and which means the Fed is unlikely to cut rates going forward. Unlike the market expectation of a sharp rate cuts in the second half of this year. The lag impact of these rate hikes would then be felt on the economy, and earnings in the US are already starting to get downgraded because of the same. We see a tremendous amount of downward pressures on global equities because of that. Having said that, India is relatively better placed. If you look at the data coming out of India, in terms of PMI numbers or the GST number, which for April came at the strongest ever, India is slightly better placed. Even in terms of inflation, it is a lesser concern when it comes to India, as especially with the crude oil prices being at a manageable level. And finally, RBI did not have to raise rates as steeply as the rest of the world, and that is why large part of the risks are going to be global risk and not so much of India specific risk. We think India could do well over the long term. Currently, we are neutral Indian equities, given India's resilience and valuations being closer to historic level. However, we want to see the current earnings season and how that pans out before we revisit that tactical call. When it comes to fixed income, we believe bond yields have peaked. RBI has already paused in the last monetary policy. We think bond yields are headed lower, and investors should look at allocating more money to duration going forward. Of course, keeping in mind the overall risk profile. We think gold is an interesting asset class, and we have been talking about it for a while now. In an environment where inflation is high and growth is low, a stagflation environment, gold typically tends to do well. And to add to that, the dollar is weakening, and a weaker dollar is also supportive of gold historically. And hence, despite the gold touching a new all-time high, we think even at current levels, gold may make some sense, and we are overweight gold even now. So that's how I would summarize our views on the current asset allocation.
Yeah, to that, maybe I'll just add in terms of what's our in-house view, especially we being an asset manager in the performing credit space. What we have seen early signs of the rates normalizing, and in fact, we have seen rally in, for example, the 10-year G-Sec cooling off by almost 35 basis points over the course of last 1 month. What that would mean is actually that the credit spreads which were narrowed earlier would actually now elevate a bit and in fact expand. And we have seen cooling which has sort of happened, or spreads contracting, or the absolute yields contracting in the second place. While the segments which we sort of usually cover, those segments we will not see the yield compressions. And that may be an aid towards the credit spread will actually expand, which may have a positive impact towards the investor's allocation. An important question, especially given, for example, we've just passed the budget and all of us had a surprise in last week of March, where we have seen the MF taxation on debt getting aligned to other debt products. And in Feb 1st, we also seen standalone bond issuances through MLDs having a tax impact. With this backdrop, our assessment or our view is that all this should ideally benefit pooled products including mutual funds, PMS, and AIFs. Just a example of, for example, in a pre-budget era, the comparison usually sort of have to happen on post-tax, where even at a net pre-tax returns of 13.5, 14, which many of the AIFs today generate, their post-tax alpha was meager 100 to 150 basis points. And that actually made a very difficult proposition for investors to allocate to AIF, given that the post-tax was not much. Today, that environment changes drastically, and now post-tax comparison actually not important so much. The pre-tax alpha by which the AIFs can offer is in the range of 600 to 700 basis points. You being a wealth manager, what is your advice to your clients, and how do you see this changing the debt allocation to MFs?
Sure. Before when there was this tax arbitrage, I think the investment decision being taken were not so much on the whether the instrument would give a higher pre-tax return. I think the final decision sort of rested with the tax decision, the post-tax return, as you sort of highlighted, which meant that investors were more keen to do debt mutual funds and MLDs and avoid taking higher risk of say a structured credit fund or alternatives like that, as they did not compensate enough for the incremental risk that one took on a post-tax return basis. However, what we had seen start even then was that the environment which was the space which was vacated by the credit risk mutual funds after the Franklin incident had made some investors at least interested in the structured credit risk AIFs. However, the uptake on those was limited. With the removal of the tax arbitrage, what has happened is that these AIFs have become much more attractive, and there are merits to investing in them. First thing is that they are closed-ended in nature, so the open-ended, the issues, the liquidity risk that a credit risk mutual fund used to have earlier gets taken care of by the closed-ended nature of these AIFs. Secondly, these AIFs tend to have dedicated teams looking at only managing, these AIFs, and the level of diligence tends to be higher. And finally, now with the taxation change, the pre-tax as well as the post-tax returns are quite attractive. What we are suggesting our investors is to allocate some amount of money to, structured credit funds. Of course, one has to keep in mind the higher risk that one is taking for the higher return that one is generating. However, for the right set of clients, some allocation to some of these structured credit funds definitely makes sense right now.
Yeah, okay. The question which I wanted to put up is that given that the traditional thesis of equity and bonds being inversely correlated, there is, I think, a global hypothesis that thesis or that correlation is sort of not working anymore.
Yeah.
And we've recently seen, let's say, BlackRock putting up a paper which says that 60-40 bond equity allocation no more sort of holds. And they've recommended adding more alternatives in clients' portfolio. You being again a wealth manager, given that, for example, AIFs, especially debt AIFs, provide in a way sort of near market neutral strategies because the returns of this AIF are not impacted by MTM because those funds are typically closed-ended. How do you see AIF and especially credit or debt AIFs having an increased allocation and maybe even some portion of the equity allocation which the clients would allocate to one higher risk, a higher return? Do you see that moving towards AIFs?
So the correlation that we tend to see between equities and bond typically tends to break during certain times, especially in times when the interest rate is rising, and this is something that we have seen historically as well. However, we don't believe that this correlation is completely broken, and it is the death of 60-40 portfolio, as some of them are calling it. We still believe a large part of the portfolio needs to be invested in traditional equity and bonds. The route to market can vary investor to investor. However, the core of the portfolio still needs to be invested in traditional equity and bonds. On the alternate side, we have always been proponent that some amount of money, both in terms of equities and debt, needs to be allocated to alternative investment. When it comes to equity, one would do investment in private markets via VC, PE funds. And when it comes to debt alternatives, one should look at structured credit funds at any given point of time. These instruments tend to are not mark-to-market instruments and tend to appear that they are market neutral, and the volatility that way visible to a client gets reduced. There is, of course, inherent risk, but because of the decline in NAV movement or the mark-to-market impact, they can help in creating some amount of stability to the overall portfolio. These instruments become even more relevant in a time when the interest rate, is rising. However, we believe that at any given point of time, some allocation to alternatives, both on the equity, debt, some allocation to gold, should always be done in the portfolio. And we suggest investors to do between 20-25% of their portfolio allocations to alternatives at any given point of time.
Yeah. Thanks. So with that, I wanted to sort of move to the recent regulatory changes, and you've seen a flurry of changes coming from the regulator over the course of last quarter or so. And one of the key change, I think, was regarding the way the wealth partners gets compensated on upfronting being capped to a certain extent in case of Cat 1 and Cat 2. And more so, especially in case where, for example, SEBI has mandated introductions of direct plans in AIFs.
Yeah.
We as asset managers, for example, were early advocates of having direct plans in our AIFs from the start. But I believe that there are a large portion of the investor community, given that the AIFs are still very, very opaque. In mutual funds, for example, you have SEBI categorization, which is very, very crystal clear in terms of what the underlying schemes can do. Given that here the segregation of underlying risk, you have so many asset managers. The role of wealth counters like yours is still very, very high, and we want to learn your views on how you would want to sort of position towards that for your investors.
Right. What I think is, and what I think is that it's not just about opaqueness. It's also about the type of investments, that an AI tends to do. As the name suggests, the investments would be in alternative assets. These are assets which are typically more difficult to understand than the traditional asset classes, equity and bonds. And thus, the need for an investment advisor, a distributor who can handhold, who can explain the intricacies with these asset classes, the risks and the return profile and the nuances to these portfolios is higher. The relevance for an advisor, for a distributor, while investing in these products becomes much higher compared to, say, mutual funds or for that matter, even PMSs. And additionally, unlike mutual funds, typically for these AIFs, the investor relationship functions tend to be much smaller, and hence the servicing capability also tends to be limited compared to mutual funds. Also, what we suggest is that an investment manager should focus a lot of his time on investment management and not client management, and that's where an advisor / distributor can add value to both clients as well as the AIF manager eventually. And that's a reason why we haven't seen an uptick in the direct plan, even though the option to do a direct plan was always there. What we believe is, even going forward, wealth managers will continue to remain relevant, despite the introduction of a direct plan. The other part where you talk about the upfronting bit, I think that's an important change that the regulator has done, especially when it comes to category 3 AIFs. A lot of category 3 AIFs were investing in plain vanilla long only equities, and the wrapper was just providing an opportunity to make some of these fee upfronted by adding unnecessary lock-in into a otherwise liquid instrument, otherwise liquid asset class. I think that gets completely taken away. When it comes to category 1 and category 2 AIFs, most of them tend to be closed-ended AIFs. There, a little bit of upfronting actually helps, because some of these products tend to be very long-term. For example, a VCP fund would be 10-12 year fund, and if the RM as well as the distributor is going to get paid over the 10 years, then the ability to sell becomes that much more difficult. The final outcome where the SEBI has allowed a part of it to be upfronted, I think is a good outcome, is a good investment, is a good decision. When the final circular came out. So overall, I think relevance of wealth managers remains despite the introduction of a direct plan and the change in the upfronting that we are seeing right now as well.
Yeah, especially given where the AIS industry, if we sort of take it, just a decade old, and I think given where US markets, for example, or other developed markets in terms of alternatives are, I think it's a good change, and which I think would help the AIF industry from a long-term perspective, because at least some amount of mis-selling which may happen in some pockets may get reduced or minimized. While given that the penetration is still very low, especially in beyond the top 5 to 10 cities, it's important that the incentives are still there for the wealth partners and RMs to still discuss this product, which is obviously much more time consuming, much more complex and difficult in terms of conversions. So we also have the same view that I think SEBI is sort of moving in the right direction in terms of the regulations. And just maybe the last question, given that we have seen some amount of regulation changes already happened, the taxation change which was like a game changer event for the debt AIFs. Do you feel there are pockets of any other regulatory changes or any other piece of taxation which needs to be aligned to ensure that the AIF industry continues the growth momentum?
As we were discussing earlier on, some of the changes that need to happen is the taxation change of the category 3 AIFs, which are right now taxed at a trust level, at a fund level, and don't have a pass-through taxation. I think that becomes a little bit of a complication. When it comes to category 1 and category 2, those are anyway pass-through taxation. So I think that is some change that the regulator could look at doing over a period of time. Otherwise, the regulatory framework is quite stringent. Actually, is in fact a little extra stringent. There are room for a little bit of flexibility. And again, as we were discussing, for some of the alternate asset classes like hedge funds, etc., in India to become much larger, investment there needs to be flexibility in terms of the investment approaches that these funds could take. The kind of leverage that they could take and the asset classes that they could invest in. I think that is a important part of the regulatory reforms that the government needs to look at if we want the AIF industry to become much larger portion of the overall AUM that we're seeing.
Okay. With that, I think we can sort of wrap up the session. Thanks, Alekh, for your valuable time and key insights for our audience. Thanks very much.
Thanks, Alekh and Dipen, for carrying out such an insightful session. It was extremely fascinating for us to learn about the potential that the AIF industry holds, and the reasons are varying, and they range from underpenetration in the HNI segment to the recent tax amendments. Hope everybody enjoyed the session as much as we did recording it, and we look forward to organizing many more of these in the future and truly demystifying the alternates. Thank you for being with us, and we will see you next time.